Hi, everyone. Thanks for joining us this morning. My name is Jess Stauth, and I run the quant research team at Quantopian. I'm going to be talking today about crowdsourced alpha, the search for the holy grail of investing. And I'll be talking about some work done not only by myself, but also by Justin Lent and Thomas Vicky, who work with me on my team at Quantopian. All right, so what do we mean by reaching for the holy grail of investing? So the pseudo quote that I'm going to use to motivate this talk is from Ray Dalio, where he said something along the lines of uncorrelated return streams are the holy grail of investing. And this plot has some simulated results that are intended to illustrate this. Along the x-axis of this plot, we're looking at adding additional return streams or instruments to a portfolio. And on the y-axis, we're looking at the resulting Sharpe ratio of the entire portfolio. So as we move along the x-axis, we're simulating holding 5 assets or 10 or 15 all the way up to 35. You could also think of those as return streams that are individual return streams or individual algorithms that we're combining to form into a portfolio. And what we're showing on the y-axis is what is the resulting Sharpe ratio of that portfolio level return. And all that varies as we move up from the lightest red to the darkest red curve is the average pairwise correlation of those return streams that we're adding together. So if you follow the lightest curve from left to right, you see that you can go ahead and add together as many correlated assets as you want. You can basically add more and more of the same exposure, and you don't really get any marginal benefit in your portfolio level Sharpe ratio. Which is your risk-adjusted return, let's say, your returns over your volatility. But if you step up to the darkest red line, that line is assuming basically a perfect lack of correlation or a 100% uncorrelation between any two assets in your portfolio. And there you see that you continue to get a marginal benefit by adding more and more return streams, and it's a pretty steep curve moving up and to the right. All right, so that sounds pretty straightforward. So why is it so hard then to find this holy grail? Really, that's due to a number of reasons. The first one I'll talk about is, okay, finding any positive Sharpe return streams that are consistent is challenging. So it's a moving target, which requires ongoing research effort really to keep finding the holy grail over and over again. So this isn't sort of a one and done type of process. The second challenge is that commonly in the asset management business, investment teams will have narrow and deep expertise, which makes it challenging to surface new uncorrelated strategies. So you'll have a team of typically, 1 to 3 or 4 portfolio managers. They have a lifetime of experience that has afforded them a lot of knowledge about some specific area, but to have that real breadth of experience to continue to surface really different ideas every day turns out to be reasonably challenging. So having said that, there are some examples of large multi-manager firms with many managers with a broad range of experience, and when you see those examples, they can be extremely successful. So examples we might think of would be places like Millennium. So that's great. However, the barrier to entry into that type of business with a traditional model is very high. So you have to have many experienced, really successful managers, and you have to get them to all band together into effectively a cooperative enterprise, kind of emerge into this really sophisticated model all at once. It's just a high barrier to entry. So here at Quantopian, we have thought a lot about approaching this problem with a non-traditional model, which is crowdsourcing. So crowdsourcing has become one of those buzzwords that's been used to the edge of overused in the past few years. So I wanted to sort of go and harken back to the definitive source of truth on the internet, Wikipedia, and just take a minute to read the definition on, as Wikipedia sees it, of crowdsourcing, which is the process of obtaining needed services, ideas, or content by soliciting contributions from a large group of people, especially an online community, rather than from traditional employees or suppliers. So when you think about what we've built at Quantopian, it fits this model really well. So we've got a large online community. I can't remember, I took this snapshot probably a couple weeks ago at this point, but we've got something like 40,000 plus registered users growing every day. Over half of that user base is outside of the United States. So if you take a look, this geolocation plot is just basically a snapshot of, from that time point, where our users were logged in from over a prior 24-hour period. So you can get a feel for the global extent of the community. So given that we have got the power of the crowd behind us, the next question really becomes, how do we engage the crowd in providing this service, the service of uncorrelated return streams? There's got to be an incentive, right, for them to contribute, for you guys really to contribute. So when we were thinking about what is the right way to bootstrap into this incentive, right? We don't sort of start out with having a crowdsourced hedge fund with this huge pool of capital sitting behind an idea. That's not typically the way that it works. A huge pool of capital typically seeks a long successful track record. So really the first tangible incentive that we came up with to offer was a paper trading competition that we opened this past January. So for those of you who might not have heard about the Quantopian Open, it's a paper trading competition where, starting in January and going through, it's been running up through this month, we award a $100,000 proprietary trading account each month to the algorithm that wins this contest. And that winning algorithm runs against our prop trading account in a real brokerage for 6 months. And at the end of that 6 months, the author keeps 100% of the profits that they've earned. So, relatively modest-sized proprietary trading account, but on the other hand, the revenue share, sort of as it were, with the algo author is 100% in their favor. So that's sort of the incentive that we started off with. The way that this works today is this is just drilling in to an individual person's drill down page on the leaderboard. This happens to be someone I know personally, Wayne Nielsen. So drilling into an individual page, you can look at the metrics that we use to rank all the algorithms in the contest. So currently, we look across 7 measures that we use to rank, and then we display an additional 8th measure. So we're ranking based on annual returns, annual volatility, Sharpe ratio, drawdown, a stability metric, the Kalmar ratio, and the beta, which is basically the correlation with the market. We also display, but don't currently rank on, the average pairwise correlation to all of the other algorithms in the contest. So Wayne could look and say, okay, I'm about 25% correlated with the other strategies in the contest so far, but we're not actually using that score to boost or penalize his rank. So up to this point, we've really viewed the Open as a laboratory for iteration and testing of our automated selection process. One example is in the 2nd month after we launched the contest, we added this green circle, which is a consistency metric that basically looks at the returns distributions from the backtest period and from the out-of-sample live trading period, and tries to come up with a pretty basic estimate of how likely it is that those returns are drawn from the same distribution, and uses that as currently it's used as a penalty function. All right, so that's all great. Once we've been running the contest for a few months and really looking at what are the algorithms coming in, sort of trying to assess basically how well this crowdsourcing plan is working, one of the first things we realized was that a lot of the algorithms submitted to the Open showed a very strong correlation to the market. That made sense, I think, for a lot of reasons. Was sort of like the easiest first thing for people to try out, and it's something that we showed a lot of examples based around long-only strategies on the platform. But because the algorithms were often correlated to the market, they were consequently all pretty correlated with each other. And that kind of works against us if you think back to that first slide that I showed, where what we're really looking to achieve is finding lots of diverse uncorrelated strategies. This plot shows that in a historical simulation that we ran, very few algorithms were passing our maximum threshold for correlation per month. So if we have something like only 20 to 60 algorithms to choose from, then you can imagine any sort of selection model that we put on top of that is going to be kind of hard pressed to come up with something really interesting. So what our first kind of realization was that we need a larger pool of uncorrelated return streams to source from for the fund. So last month we adjusted the contest rules to try to address this. So we announced a scoring change really designed to sort of incent or give people the feedback to spread out and try to create something that is not correlated with the market. And what we did was we introduced a beta badge, which looks like this little blue button you can see next to Tibor and Andy's name. And when you hover over the beta badge, you get the description that we're computing your average beta to the SPY, ETF that tracks the S&P 500, over the past year. And algorithms which have that trailing year beta of a value between positive and negative 0.3, which means that you're, less than 30%, let's say, correlated with the market. So if you meet that bar and you stay within that constraint, then you're ranked above all of the algorithms that don't meet that bar. So we're effectively reshuffling the leaderboard and putting low beta algorithms to the top. So we're seeing early signs that the crowd is moving in this direction and submitting more stuff to the contest that's low beta, but it's really still early. So at this point, there's a really large opportunity to kind of get out in front, I think win this contest and get your strategy into the fund. And what I'm going to do is talk a little bit more about the specific things that we're really looking for when selecting algorithms out of this contest entry period and actually into the fund that we're in the process of creating. All right, so I'm going to run through a couple of these what we look fors, and I'm trying to keep them, pretty basic and broad. The first is, like I've been hammering on and talking about, low exposure to the market. So algorithms that aren't correlated to the rest of the stock market and fall within that band that I mentioned of between positive and negative 0.3 beta. So here's a nice example of what that might look like. Here in green are the back-tested returns to a strategy over the past 10 or so years. There's just a little bit of out of sample you can see in red, and then we have actually a linear projection forward based on the historical returns and variance of the back test, where you can see sort of what our expectation that this strategy might do in the future is. And below the equity curve, I've got a plot of the rolling portfolio beta. They're hard to see because they're very small and overlaid, but I'm computing the trailing 6-month and 12-month rolling beta to the S&P 500, and so you can see that this algorithm has maintained a very consistent and very low beta. That's right in the zone of what we're looking for. So great, you can be low beta, but what if you aren't making any money? That's not particularly interesting. So we want algorithms that show consistent and stable profits. So an algorithm that's losing money, obviously, or making money in an extremely volatile way is not particularly helpful. It's not exactly what we're looking for. And the bar that we're using as sort of a rule of thumb is algorithms that have a consistent Sharpe ratio of over 1 are, at least interesting for us to take a look at. So here's an example of, for that same strategy that I showed you, plotting a trailing rolling 6-month Sharpe ratio, and you can see that this particular strategy on average over its backtest period had a Sharpe ratio of 3, which would be considered really quite good. Even better if you actually showed something like that in live trading, or even half that. And you can see that, this Sharpe ratio, when computed on a 6-month time frame, it wanders around above and below 3, but what it doesn't do is wander, way into negative territory and way higher, right? So you could even argue, you might like this to look even a little bit tighter around its mean. All right, so the next thing that we look for is strategies that are trading actively. This means a lot of different things to different people in the asset management space. So when you see active trading, if you're thinking something like HFT, that's not sort of within the purview of what you can build on Quantopian or what we're looking for. The active trading that we're talking about is basically being able to see that we have enough data points about decisions that your algorithm is making over the course of, say, a year or two, that we can confidently say we've learned enough about this algorithm to project forward its behavior in the future, or we can watch it in paper trading for 6 months and see enough about it. So an example would be a strategy really that turns its portfolio over between once a month, and once or twice a day. That's a very wide envelope, and in the long run, I could see us actually having probably a tighter set of constraints for algorithms we put in the fund. But just to give sort of the widest possible guidance, if your strategy is not turning its portfolio value over, even for example, once per year, well, that's going to be a strategy that may be very valid in the long run, may be profitable in the long run, but it's going to be really difficult for us to evaluate its consistency and profitability, both based on the back test and based on how long we have to watch it trade out of sample to get enough confidence in its behavior. And so it's a couple plots here that I won't step through in detail that show you, for this example strategy I've been talking about, what the percent turnover on a daily basis is, what's the number of shares traded on a daily basis, and the histogram of the daily trading volume over time. All right, so this goes back a bit to the core theme I talked about at the beginning. So we talked about wanting low correlation to the market, and then you can take that one step further and say that, really for this to work, we want algorithms that have low correlation to all of the other algorithms that might be in the contest or might already be in our fund. So again, as just a rule of thumb, we're using the same plus or minus 30% average pairwise correlation guidelines for algorithms that are in the contest or the fund. And as I mentioned, while we're not scoring on those, you can take a look in your drill down page on the open, and you can see that we show you your correlation to all the other algorithms in the contest, both for your back test and then evolving as your algorithm is paper traded. So if we take a look at this algorithm by Kevin, he's got a correlation of about 5% to all the other algorithms in the back test based on running a 2-year back test, all the other contest algos. And then his strategy's been trading actually for a while now. So he submitted this, if you can see in gray here in the upper right, he submitted this on January 29th. And his strategy is still running. This snapshot might be a few days or a week or two old at this point. But he's got a pretty good amount now of out-of-sample results, and he's still within a very low average pairwise correlation to everybody else's paper trading results. So that's great. That tells us that his algorithm is not just a clone of a bunch of other things that we have to evaluate. All right, so all of those that I've mentioned so far are, if not easy, at least lend themselves fairly well to quantification, and they're things that we can try to automate, I think, in a pretty straightforward way. This next one is a lot more challenging to automate, but that doesn't mean that it's not important and that we're not thinking about it. So something that we need to look for and need to understand is that the strategies we're investing in have strategic intent. So we're looking for algorithms that are driven by underlying economic reasoning. I'm going to divorce this a little bit from, how are we going to verify this, or how are we going to bake this into an automated selection model? But I'll give an example, which is looking at some work that Simon had posted in the forums recently. So Simon's in the forums and he's saying something like, hey, here's an interesting paper that I found on SSRN. It looks at risk premia and the VIX term structure. So I read this paper, I thought it seemed interesting, and I implemented a version of this on Quantopian, and here I've shared it with all of you. So we may or may not decide, let's say, that we wanted to invest in Simon's particular algorithm, but what's really cool about it, right, is that he's giving a reference and he's explaining where it came from. To drill into that a little bit further, we can also say, great, I actually have personally met Simon when he used to live in New York, but even if I hadn't met him, I can go click through and look at Simon's profile page on Quantopian, and it's really easy to get an idea that he's a real person who's created a lot of algorithms and run a lot of back tests. He's got his profile picture up, and he's also telling me, a short bio about himself. And then if I'm interested in what he's been working on in the past, I can go through and look at algorithms that he has shared in the past and things he said in the forums. So actually, while this is really difficult for us to quantify into any sort of a selection model, we actually have a lot of information that people, optionally choose to share on the forums about themselves. And I think that actually going one step beyond automated selection of algorithms and really actually connecting with the quants that are building strategies on the platform is something that we're kind of just figuring out, I think, how to start doing, but it's going to be important to our process. All right, so change gears a little bit, and I'm not going to spend very much time on sort of the negative side, but just to sort of highlight and point out what are some things that we're specifically not looking for, and actually kind of doing our best, and I hope to keep improving on doing our best to try to bias against or guard and keep out, which are things like overfitting, data snooping, and spurious correlations. So not to dig into those too much, but here's an example of plotting a modeled returns distribution to backtest daily returns and then subsequent out-of-sample daily returns from the same strategy. And so you can get a sense that if we look at the area under the two curves overlapping, we translate that into this consistency score that I measured. And right now, that's one of the tools that we're using to try to look for whether your backtest is a good predictor of your out-of-sample behavior. And really, at the end of the day, both from our purposes of evaluating strategies and for algorithm authors looking to evaluate their own work and understand how much they might trust their own algorithms, for example, putting their own capital to work in them, trying to understand how predictive your backtest is going to be of your live trading results is really key to this whole enterprise. All right, so I've shown a couple of interesting plots. Hopefully you think they're interesting so far. And so one of the things that I wanted to talk about was that to help you better analyze your algorithm and hopefully get your algorithm into the fund, we've actually been working on giving you this access to this same tear sheet analysis that we use in-house to evaluate algorithms and to evaluate our own portfolio. And it's going to be available, I believe it's actually available with sort of an inline code module today on the research platform, which I believe everybody has access to as of now. And in the very near future, it's going to be available as its own open source library that you'll be able to just import that into research or actually use it anywhere you want off of the platform called Quant Risk. There's a lot of cool stuff in here. I've touched on a lot of the plots. There are some that I didn't go over yet today, and we're actually working pretty actively on continuing to add more and more analysis to this for you guys to use as well as what we're using internally. All right, so let's sort of jump to really where probably most people's questions lie, which is, okay, great. Let's say I understand everything that you talked about. I get what you're looking for. I get what you're not looking for. I've got an algorithm. It's fantastic. It works. It works in sample. It works out of sample. You select me for the fund. What happens now? So at this point, it's obviously an opt-in arrangement, and you've decided that you want to license your algorithm to Quantopian for us to use it in our fund. So you do that. We pay you a 10% royalty based on the profits that your algorithm earns. You retain the ownership of your intellectual property, so we don't get any claim on keeping your algorithm. And Quantopian takes responsibility for operating the algorithm, circling, finding, and allocating the capital to the algorithm, and managing the risk for the algorithm. And hopefully I've convinced all of you that if you haven't already entered your winning strategy in the Quantopian Open, you should go right out and do that today. And really that's everything that I wanted to cover. So with that, I'm going to wrap it up, and I'm going to see if there are any questions to answer. Okay, so the first question was, how are we currently measuring the correlation between algorithms? So I talked about, you want to be low pairwise correlation with everybody else. We're doing it in a very straightforward, not sophisticated way at the moment, which is we're just looking at the time series correlation of your daily return stream against everybody else's daily return stream. And so we're really just looking at, from the standpoint of a returns-based analysis. How correlated are you? In the future, there would be more sophisticated things we could do looking at risk exposures, but right now we're just looking at your returns time series correlation against everybody else. And the reason we can do that and match up the time ranges is because when algorithms are submitted to the contest, we run every algorithm on a standardized 2-year back test where they start all with $100,000 in capital. We run the algorithm for 2 years, and we get so we have sort of like a nice same size data set for each of them. All right, so the next question I have is around what is our timeline? So what's the timing that we're looking at for the fund creation? And this is a work in progress, but I can give you a bit of a preview of sort of what our own milestones are. Really, we're looking at launching the first version of the fund in the first part of 2016. Backing out from that, there are a lot of milestones that we've set for ourselves in the next 6 months between now and, say, January. So we're in the process of creating sort of an internal validation fund structure that we'll be deploying capital to in the near future. And then really basically putting all the operational pieces in place to do the fund launch in the beginning of next year. The next question I have is, for inclusion in the fund, are we looking at algorithms that aren't currently in the contest? So that's a great question. We had talked a lot when we first launched live trading on Quantopian about telling people, hey, go live trade your algorithm on your own capital. That way you're going to get a track record that we can use with real money trading, and we can evaluate those algorithms for the fund. We have looked at those algorithms, but really what we've learned is that the contest is probably going to be the richest vein for us to mine, because within the framework of the contest, we can kind of do an apples to apples comparison and put everybody on the same basis and give them the same targets to try to meet. And when you talk to people about what they might be trading in their own real money trading account, a lot of times their goals and risk tolerances and framework that they're trying to achieve with their own account might not match that closely with what we're looking for the fund. So while we're willing to look at strategies outside of the contest, that's really kind of the main place that we're looking at right now. The next question I have is, I love the relationship with Morningstar, which I'm assuming they're talking about the fundamental data that we've shared. And the question is, are there other partnerships on the horizon? So that's a great question. It's something that I didn't touch on in this talk, but is a big part of our product strategy here at Quantopian. We're in the process of building, basically, I don't know what the sanctioned name is going to be, the Data Bazaar, or I think maybe the store, but we're basically looking to offer more content that you'll be able to use natively integrated on Quantopian to run your strategy. So when we talk about looking for diversified return streams, that's with the understanding that today we're giving you access to, arguably a pretty small slice of the whole pie that's out there in terms of asset management. So you mostly have access to pricing data, and you can trade U.S. equities. Those are so there's an axis of data that you have access to that we're looking to expand. I don't have specific names I can share with you today in terms of who the next partners are, but I can definitely point you to look in the forums at some of the data vendors who've been posting algorithms they've created with interesting results. We have a lot of interest from people that have sentiment data. And then we're looking at sort of what we think are other key table stakes data sources for quants and looking at trying to add those. And then the other dimension, right, is the tradable assets. So I didn't talk about in this presentation, but we're working on adding futures trading to the platform. And so when we do that, we'll also be opening up, sort of another part of the field for trading strategies that may not be so correlated with each other. Okay, the next question is about slippage. So saying market impact or slippage is a big issue for systems that are trading a lot of capital. How do we plan to handle this, and what venue will the fund be traded on? So that's a great question. To start with, we're going to be a small fund, and especially our sort of initial operational validation account sizes aren't going to be too much bigger than what we're using in the contest. So it's not going to be an enormous problem for us day one. And for our first version of the fund that we launch, even in 2016, we're going to stay on interactive brokers. And when that becomes a problem, we'll obviously be able to move off of that venue. But it's not, I think, basically our first problem that we have to solve. There's another kind of related question, which is, what do you think about the tension between high turnover portfolios and high capacity algorithms? And what about that with respect to the allocation size in the fund? So that's a great question. There's obviously going to be a trade-off where algorithms that have a really, really large capacity maybe will not have as much turnover. I think where we're, like I said, going to be biased to start with is that we're going to have pretty small allocations that we're going to be looking to give out, and so we're probably going to be aimed a bit more at higher Sharpe and higher turnover strategies. But then that's not to say that we're going to be looking for what I would call day trading, or certainly not true high frequency strategies. So if you're familiar with the way that our platform works, we really limit you to about a minutely clock to submitting orders to interactive brokers, and your algorithm doesn't actually know what fill it got back for about a minute. So anything that's looking at trading, in the minutely scale and down to something like sub-minutely is not going to really be compatible with our platform. But something that's trading its portfolio, like I said, once or even twice a day, I think still is within the purview of something that we would be interested in looking at. The next question is really interesting, which is, how are you going to think about dropping algorithms that have poor performance or that run into problems or violations? So our first version of this, we think of this as really in the risk management part of our business. And our first version of this is going to be to do something extremely conservative and simple, which is we're going to put pretty tight stop loss constraints on the algorithms we allocate to. And when they fall below that stop loss, we're going to have specific de-risk or de-levering action. So it might be half the capital comes off at this point, the algorithm gets entirely liquidated at this point. I think, though, while we're going to have pretty tight constraints, we are going to use judgment and oversight. So we're going to write down, these are the rules where we're going to take the capital off, but we are going to look at them, both us and along with some advisors we have on our investment committee, and make sure that we're understanding the context, of the broader market environment and what that algorithm's beta is, and make sure we understand, that, okay, this isn't a case where we're turning off an algorithm that's had a 5% drawdown, but actually really in context, that's not that surprising, and it shouldn't actually be cause for taking it off. In the future, we've got a lot of stuff that we're working on from a research standpoint, where we're trying to look at how to model behavior of algorithms and how to basically capitalize on the fewest possible out-of-sample data points to get a high certainty of whether we think the algorithm is behaving as we expect from a backtest or not. And so the smarter that we can get about quickly realizing that a strategy has basically changed its regime, whether that's because the strategy has stopped working, market conditions have changed, the algorithm is broken, some set of underlying assets that are being bought have had something serious happen to them, right? Could be for any reason. We'd like to basically create a really sophisticated system for looking at that, but we're going to start off with something that's really pretty basic and simple. Had a question which was, do you plan to end the contest at any point in the near future? I hope not. So that's a great question. We don't plan to end the contest at any point in the near future. It's working, I think, extremely well from our standpoint. We do view it as really a spot for us to continue to iterate and evolve. And so I do think that you're going to continue to see us making tweaks and adjustments. One thing that we're thinking about is in I think the last announcement of rules changes that we did just a week or two ago, we talked about phasing out counting your backtest performance as part of your score. which is probably too lengthy of a topic to go into in a Q&A. But that's a good example of an evolution that we've taken in the contest to placing more weight on paper trading results. And if you think about that, it really then throws a spotlight on a 1-month paper trading competition where you'd say, okay, 1 month of out-of-sample results, 20 trading days, let's say, feels like a pretty small amount of data to make a decision about separating out the wheat from the chaff, or really consistent and high-performing algorithms from those that aren't. So one thing we're thinking about very hard is how to move towards longer competitions, which I think will be a lot more credible if you're accumulating 6 months of paper trading results. And the thing we have to weigh on the other side, right, is that we want this to be an engaging, interesting, and rewarding experience for, right, every new person who comes and finds Quantopian for the first time and wants to interact with this contest. So whether that looks like down the line having, a short run, a mid-run, and a marathon version of the contest or something like that. So we're definitely gonna keep working on the idea is for sure with the contest not to sort of be whipsawing and changing the goalposts and pointing the crowd in all different directions every month. The idea is really to be sort of heading in a specific direction, which is a high quality, credible contest that's looking to select a certain type of consistent algorithm and really kind of keep ratcheting like closer and closer to getting towards that. So I think with that, I've probably taken enough time to do Q&A. So thanks so much for attending the webinar, and I'm going to wrap it up and sign off.